Picture a battlefield. The smoke is clearing, and the sheer scale of the devastation is just, it's hard to even comprehend.
Yeah, it really is.
We're not talking about a literal war zone, though.
Mm-hmm.
We're talking about the stock market between March 2000 and October 2002. Because in that window, 50% of the U.S. stock market's value was just wiped out.
50%.
Right. That is $7.4 trillion.
Okay.
Just gone. Evaporated.
It's staggering. It really is a financial battlefield. I mean, you have fortunes built over decades, literally lost in the blink of an eye. And if you look back at the go-go funds of the 1960s, they went up in the exact same kind of smoke.
History repeating itself.
Exactly, because wealth isn't destroyed by accident in these crashes. It is systematically transferred. It goes from the emotional and the unprepared straight to the disciplined.
And that transfer of wealth, well, that's what brings us to our mission for this deep dive. Today, we are extracting the ultimate survival tactics from the definitive Bible of value investing, which is, of course, The Intelligent Investor by Benjamin Graham.
The absolute gold standard.
Truly. And we're specifically diving into the updated version, which features this incredible commentary by Jason Zweig and Warren Buffett. We've basically combed through this text to pull out the top 20 most powerful concepts to help you, the listener, build a portfolio that actually survives contact with the enemy.
And to survive that battlefield, you can't just, look at the blinking tickers on a screen. You have to start by looking at the weapon you are bringing to the fight, which is your own mind.
Right. Lesson 1.
Exactly. Lesson 1. The market is uniquely designed to break human psychology. We assume that if you are smart enough, if your IQ is high enough, you can just outsmart the market. But Graham shatters that illusion immediately. Character and discipline will always beat raw intelligence.
And there is no better or honestly more tragic story to illustrate this than Sir Isaac Newton. I mean, we are talking about the man who literally calculated the motions of the heavens, the father of modern physics.
A literal genius.
Right. So back in 1720, he invested in the South Sea Company. And he actually sensed the market was getting manic, so he sold his shares and he walked away with a massive 100% profit.
Which is great, right?
You'd think so. But the story doesn't end there.
Far from it. He stepped away, but the crowd just kept buying. I mean, the hype grew to an absolute fever pitch. So Newton had to sit there and watch all of his friends get absurdly rich while he was, just sitting on the sidelines.
The FOMO was real, even in the 1700s.
Oh, the psychological torture of missing out was just too much for him. This certified historical genius couldn't resist. He jumped back in at a much higher price, and when the bubble inevitably burst, he lost 20,000 pounds.
Wow.
Yeah. In today's money, that is over $3 million.
$3 million. And he later muttered that he had calculated the motions of heavenly bodies, but not the madness of the people. Okay, let's unpack this, because that Newton story, it really sticks with me.
It's a powerful lesson.
It is. If IQ is the engine of a sports car, then emotional discipline is the steering wheel.
Right.
A massive engine without a steering wheel just means you're going to crash into the wall that much faster. You can have the highest IQ in the room, but if the crowd is cheering and you lose your cool, your portfolio is completely totaled.
What's fascinating here is why we are so prone to crashing into that wall. Our brains are, they're biologically hardwired to fail in financial markets.
Because of evolution.
Exactly. We are pattern-seeking animals. If you show a human a random, totally meaningless sequence of numbers, our brains will instinctively try to predict the next one. We can't help it.
We want it to make sense.
Right. Combine that with a deeply ingrained survival instinct to follow the herd. When everyone else is running in one direction, our biology screams at us to follow them because historically, staying with the pack kept you alive.
But in investing, following the pack gets you slaughtered.
Exactly. So if a literal genius like Newton can get slaughtered by the herd, intelligence clearly isn't the shield we think it is. Which brings us to lesson 2. Graham argues that your only real protection is defining the game you are actually playing.
The line between investing and speculation.
Yes. He draws a brutally strict line in the sand there. He defines an investment incredibly narrowly. He says it is an operation that, upon thorough analysis, promises safety of principal and an adequate return. Period.
Everything else is speculation.
Right. And that thorough analysis part is where most people fail. If you are buying a stock just because the chart is going up or because your neighbor gave you a hot tip, you are not investing.
They're just gambling.
Exactly. If you don't understand the underlying business well enough to know your principal is safe, you are speculating. And the very first step to financial survival is simply admitting when you are gambling.
Which requires a pretty massive perspective shift on what a stock actually is, which is lesson 3. A stock is not a blinking green or red light on your phone. It isn't a digital betting slip.
Not at all.
When you buy a share, you are taking a literal ownership interest in an actual physical business.
And because you own a piece of a business, for lesson 4, Graham introduces you to your new business partner. He asks you to imagine this manic depressive guy named Mr. Market.
I love this analogy.
It's the best. Every single day, Mr. Market knocks on your door and offers to buy your share of the business or sell you his.
But the catch is, Mr. Market's mood swings are terrifying.
Oh, completely wild.
When he's manic, he sees nothing but sunny skies, and he quotes these absurdly high prices for the stock. But when he is depressed, he thinks the world is ending, and he's willing to sell you his shares for just pennies on the dollar.
Right. And the fatal mistake most people make is looking at Mr. Market's daily quotes as a true reflection of the value of their business. They let Mr. Market dictate their reality.
They let him drive the sports car.
Exactly. Graham's rule is that Mr. Market is there to serve you, not to guide you. You must be his master. You don't have to trade with him just because he's standing on your porch screaming.
Right. But, if our brains are wired to follow the herd, and Mr. Market is standing there yelling that the sky is falling, how do we rationally figure out what a stock is actually worth?
Well, that brings us to lesson 5 and the brutal law of pricing. Price dictates return. The future value of your investment is entirely a function of the present price you pay.
So the higher the price you pay today, the lower your return will be tomorrow.
It is the absolute law of gravity for finance. A great company bought at an absurdly high price becomes a terrible investment, period. And this is why, for lesson 6, Graham demands you establish a margin of safety.
This is the core of it all.
It is. Warren Buffett summarizes this brilliantly in the text. He says, when you build a bridge, you insist it can carry 30,000 pounds, but you only drive 10,000-pound trucks across it.
You leave an enormous margin for error just in case, your calculations were wrong or a crazy storm hits or the unexpected happens. But how does a bridge analogy actually work in the stock market?
In finance, the margin of safety means demanding a discount. You calculate the intrinsic value of the business based on its assets and cash flow, and then, and this is key, you refuse to buy it unless Mr. Market is offering it at a price significantly below that value.
Okay, so give me an example.
Say you calculate a stock is worth $50. You don't buy it for $50. You wait until Mr. Market is depressed and offers it for $30. That $20 gap is your margin of safety.
Right, so if your analysis was slightly off, or the economy just hits a random recession, that buffer absorbs the damage so your principal remains safe.
Exactly. And understanding that makes the trap of growth stocks, which is lesson 7, so obvious, yet it's where people consistently get wiped out.
Oh, because they assume obvious growth equals obvious profits?
Yes. Look at the airline industry in the 20th century. It had spectacular, world-changing physical growth. Suddenly everyone was flying across the globe, yet it was a total financial disaster for investors. Cumulative earnings for the entire aviation industry over its history were essentially negative.
Wait, really? Negative?
Negative. Because the capital required to build and maintain those airplanes was astronomical, and the competition was just ruthless. The physical expansion of an industry tells you absolutely nothing about its ability to generate surplus cash for shareholders.
Wow.
Contrast the airlines with the dot-com bubble. The text looks at the Monument Internet Fund in 1999. The manager of that fund publicly predicted 35% annual returns for the next 20 years, simply because the internet was obviously the future.
And what happened? By 2002, a $10,000 investment in that fund had shrunk to roughly $2,000.
Brutal.
But here's where it gets really interesting. I want to push back on this a bit. Because, if a company or a technology is genuinely changing the world like commercial flight or the internet or, say, artificial intelligence today, why shouldn't we pay a massive premium for it? The innovation is undeniably real.
The innovation is real, yes, but the investment is ruined by the hype. Think about the actual mechanics of the market. Once an industry is obviously the next big thing, well, everyone else knows it too.
The secret is out.
Right. The crowd has already rushed in and bid the price of the stock up to the stratosphere. If the price is already assuming perfect execution and massive growth for the next 20 years, the future returns have literally nowhere to go but down. Any tiny stumble, any slight delay in that perfect future, and the stock price just collapses. You have zero margin of safety.
Which perfectly explains lesson 8. Why initial public offerings, or IPOs, are such a total bloodbath during bull markets.
Oh, absolute carnage.
When a company first goes public, there's this like carnival-like atmosphere. The investment banks hype them up, the financial news hypes them up, but Graham warns that for every dollar you make in these sure things, you are eventually going to lose too.
Because the insiders and the investment banks are the ones selling the stock to you. They are timing the IPO for exactly when Mr. Market is most manic.
They know exactly what they're doing.
They are specifically pricing it to extract maximum cash from the public. If it were a genuinely underpriced sure thing investment, the original owners wouldn't be selling it to you in the first place.
So true. Okay, so if we know that paying too much for the next big thing is a fatal trap, how do we actively manage our money when the market is fluctuating? That's lesson 9. You have to completely flip your emotional perspective on what a good market is.
Yes, you have to realize that bear markets reduce risk and bull markets actually increase it.
Which sounds totally backwards to most people.
It is the ultimate contrarian mindset. The intelligent investor actually dreads a roaring bull market. Why? Because prices are high, which means your margin of safety is shrinking rapidly and stocks are becoming very dangerous to buy.
And conversely, they welcome a bear market.
Right. A bear market means Mr. Market is depressed and he's putting high-quality businesses on sale. The real risk isn't when prices have crashed and there's blood in the streets. The actual risk is when prices are at all-time highs and everyone is euphoric.
And getting swept up in that euphoria leads to lesson 10, the trap of extrapolating the past to guarantee the future.
The Dow 36,000 mindset.
Exactly, that book that infected the late 90s. People looked back and saw that stocks historically returned about 7% after inflation. So they just assumed that because it happened in the past, they could just draw a straight line pointing up forever.
They completely ignored the fact that they were starting from incredibly overpriced levels.
Right. And you can't rely on mechanical magic tricks to save you from those overpriced levels either. Which brings us to lesson 11. The folly of formulas.
People love a formula.
They do.
Yeah.
The text details things like the foolish four or the January effect. People love to find a statistical anomaly in historical data, a pattern that worked in the past, and they just assume it's a permanent law of physics.
But it never works out that way in real time. By the time a mechanical formula is published in a book or discussed on financial TV, the entire market knows about it.
The edge is gone.
Exactly. The crowd rushes in to exploit that exact inefficiency, and the arbitrageurs instantly close the gap. The formula loses all its power the exact moment it becomes public knowledge.
Which is why Graham relies on structural defenses rather than gimmicks. This is lesson 12, and it's a big one. He insists on a rigid asset allocation rule. Keep a minimum of 25% of your portfolio in bonds.
Even if you are an aggressive investor.
Even if you love equities, you must have that anchor. But wait, I have to push back here.
Sure.
We just talked about inflation, and we know stocks historically yield significantly more than bonds over a 30-year period. So isn't holding 25% in low-yielding bonds just dragging down my total wealth? It feels like driving that sports car with the parking brake on.
It does feel that way. But if we connect this to the bigger picture, you'll see the bond allocation isn't actually about the financial math of compounding.
What is it about?
It is strictly about emotional survival. Psychologists have proven time and time again that we are terrible at predicting how we will actually feel during a traumatic event. You might think, sitting here today, that you can stomach a 50% drop in your portfolio.
Easy to say right now.
Right. But when the market actually plunges and the economy is tanking and your screen is bleeding red every single day, the panic is completely overwhelming.
The biology takes over.
Precisely. That 25% in bonds is your psychological anchor. When your stocks are plummeting, your bonds usually hold steady or even go up.
So it softens the blow.
More than that, looking at that stable portion of your portfolio proves to your primitive brain that you aren't going to zero. It gives you the raw courage to hold on to your stocks or even rebalance and buy more when Mr. Market is absolutely terrified. Without that bond anchor, the pain becomes just too much, and you are highly likely to panic and sell at the exact bottom.
So the bonds are really an insurance policy against your own worst instincts.
Exactly.
Okay, so once you have that anchor in place, you still have to select the right equities for the other 75%. But the market sets solutions here too, which is lesson 13, the buy what you know trap.
Oh, this is a dangerous one.
The text uses Barbara Streisand as an example. She famously said, "We go to Starbucks every day, so I buy Starbucks stock."
And, it sounds incredibly intuitive. It's largely a corruption of Peter Lynch's famous advice about using your local knowledge to spot trends.
Right.
But buying a stock just because you like the taste of the coffee while completely ignoring the valuation, the debt load, and the actual financial statements is a recipe for disaster.
It's insane. It's like thinking you can fly a Boeing 747 just because you've ridden in first class a few times.
That's exactly what it's like.
You know what the consumer product feels like, sure, but you have no earthly idea how the mechanics actually operate under the hood.
And worse, knowing the brand gives you a false sense of security. You just stop looking for the warning signs. Instead of chasing familiar consumer brands at sky-high prices, Lesson 14 says we should look at the unpopular large companies.
The ones nobody wants to talk about.
Right. Graham tells this incredible story of A&P, the Great Atlantic and Pacific Tea Company. In 1938, their stock crashed to 36. At that price, you could literally buy the entire company for less than its working capital.
Meaning you could buy the company, pay off all its short-term debts, and the liquid cash and inventory sitting in the business were worth more than what you actually paid for the stock.
Yes. You were getting the actual buildings and the historic brand completely for free.
That's wild.
The market constantly makes mountains out of molehills, driving the prices of fundamentally sound, massive companies straight into the ground over temporary setbacks or bad headlines.
But how do you actually know if the company is fundamentally sound? Because let's be honest, the numbers they report can be a trap too, which is lesson 15. You have to ignore single-year earnings.
Never take 1 year's profits seriously.
Right. The company might have a sudden burst of profitability due to a one-off contract or just some economic fluke. You must look at a multi-year average. Graham suggests 3 to 7 years to see the real underlying trend.
And you have to be vigilant because corporate accounting is incredibly manipulative. This is lesson 16. Beware of accounting illusions.
The smoke and mirrors.
Exactly. The text highlights companies like Global Crossing. They manipulated the reported earnings by treating normal, everyday operating expenses as capitalized assets.
Mechanically, what does that actually do?
Okay, let's say a company spends $1 million fixing fiber optic cables. That's a daily maintenance expense, right? It should instantly lower today's profit by $1 million.
Makes sense.
But instead, they disguise it on the balance sheet as a long-term asset. They claim that maintenance added permanent value that will depreciate slowly over 10 years.
Oh, wow.
Right. So suddenly, millions in cash are bleeding out the back door, but the profit statement looks pristine. It's basically financial gaslighting.
That's terrifying. And the text also calls out Micron Technology for a totally different trick. They had massive inventory write-downs, meaning their products were obsolete and worthless, but they treated those write-downs as one-time, extraordinary events.
Nothing to see here.
Exactly. They tried to tell investors, hey, ignore this massive loss. It's just a fluke, rather than admitting their core business was actually struggling.
Earnings are highly malleable. That is why Graham demands a two-part appraisal process. You filter for past performance, absolutely, but you also need strict, unbendable, quantitative filters.
Like what?
You demand that current assets are at least double current liabilities. You demand a long history of uninterrupted dividend payments. You use these rigid mathematical walls to protect yourself from that accounting smoke and mirrors.
And peeling back all those layers of accounting fraud brings us to the ultimate reality of investing, the math of survival. Lesson 17 is maybe the most terrifying part of the text, the brutal math of loss.
The math of loss works exponentially against you. If you suffer a 50% loss in your portfolio, you don't just need a 50% gain to get back to zero.
You need a 100% gain just to break even.
Exactly. And if you lose 95% of your money, which, by the way, happened to a vast number of tech investors in 2000, you have to achieve a staggering 1,900% return just to get your original principal back.
A 1,900% return is, that's virtually impossible.
Which is why avoiding catastrophic loss isn't just a good idea, it is the supreme directive of the intelligent investor. You cannot compound wealth if you are constantly digging yourself out of a crater.
So, to avoid digging that crater, Lesson 18 offers a mechanical defense. Dollar cost averaging.
The ultimate shield.
Truly. It's the best defense against trying to time the market. Instead of trying to guess when Mr. Market is depressed, you commit to regular, automated monthly purchases of stocks through thick and thin. You buy whether the market is at a record high or sitting in the gutter.
And mechanically, this means you automatically buy more shares when prices are cheap and fewer shares when prices are expensive.
Right. And you combine that automated buying with Lesson 19. sweeping diversification.
You have to, because we cannot predict the future. We don't know which specific company will invent the next great technology or which will fall to accounting fraud. So you can't just look for the needle in the haystack.
You can own the whole haystack.
Exactly. By broadly diversifying, you ensure you capture the few companies that go on to generate massive market-beating returns while cushioning yourself against the inevitable bankruptcies.
And if you are going to pick individual stocks, Lesson 20 says you have to act like an owner, not a sheep.
This is a big one.
Historically, shareholders act like sheep. They just rubber stamp whatever management wants, voting yes on the proxy statements, no matter how terribly the company is performing or how much the executives are paying themselves.
The intelligent investor has to snap out of that. If you own the business, you must aggressively monitor management, read the proxy statements to see where the money is going, and demand accountability.
And if management is destroying the intrinsic value of the business, the owners must stand up and force a change.
Absolutely.
So what does this all mean? I mean, if we shouldn't try to beat the market with algorithms, and if we shouldn't trust our own biological instincts, and we shouldn't pick individual stocks unless we are willing to do a massive amount of investigative counting, what is the everyday listener actually supposed to do with their savings?
Well, this raises an important question, and it is really the absolute crux of the modern application of Graham's work. Graham makes a distinction between the enterprising investor who has the time to analyze balance sheets and the defensive investor who does not.
Which is most of us.
Vast majority of people. And for the defensive investor, the ultimate solution is a low-cost index fund.
It is the perfect autopilot mechanism.
It is. It gives you extreme immediate diversification. It costs next to nothing in fees. And most importantly, it completely removes the temptation to trade.
By buying a piece of the entire economy and just holding it forever.
Right. You capture the market's long-term return without ever having to negotiate with Mr. Market's manic, depressive mood swings.
When we pull all of these 20 concepts together, a very clear picture emerges. If there's one thing this deep dive proves, it is that investing is not a war against the hedge funds, or the high-frequency algorithms, or the investment banks.
Not at all.
It is a war against your own worst instincts. Your biology wants you to buy high when everyone is cheering and sell low when everyone is panicking.
And the intelligent investor is the one who builds a fortress of discipline through a strict margin of safety, an emotional anchor in bonds, and the humility to diversify just to survive that battlefield.
Ultimately, financial survival comes down to how you handle the unknown.
Which leaves us with a final provocative thought to take with you. In the commentary of the book, financial thinker Peter Bernstein applies Pascal's wager to the stock market.
Oh, this is fascinating.
In theology, the philosopher Pascal argued that you should live as if God exists, regardless of the odds, because the consequences of being wrong are eternal. Bernstein applies this exact logic to your money.
How so?
Well, in investing, you can never truly know the probabilities of the future. Will inflation spike? Will tech collapse? The future is entirely uncertain. Therefore, because you cannot predict the probabilities, you must control the consequences of being wrong.
So ask yourself this. When you look at your portfolio today, are you betting your entire financial life on the mere probability that your predictions are right? Or have you built a margin of safety to protect yourself from the catastrophic consequences of being wrong?
Thank you for joining us on this deep dive. Stay vigilant out there.
You have the tools now. Don't let Mr. Market tell you what to do.